Hi, everyone. This is Jason Bierk of Wall Street from East Street. Welcome back to another Wall Street from East Street podcast interview. Today, John Manfreda and I are joined by a returning guest. He's one of our favorite guests. We listen to the McAlvany weekly commentary basically every single week. We've been doing it for years. I don't think we've missed one since I started listening about 4 or 5 years ago. David McAlvany is a second-generation money manager. He owns a precious metals dealer. He's a money manager, and he also has the very popular McAlvany weekly commentary that I think everyone should listen to. It's very thought-provoking. Thank you for joining us again, David.
Great to be back with you both.
Okay. My first question is, when it comes to the stock market, a lot of people use the retail indicator, rather basically the retail investor's not in it, so we're not close to a top. My opinion is so much has changed since the 80s and 90s that a third of Americans don't have even $10,000 in the bank. 2/3 live paycheck to paycheck. In your opinion, is the retail indicator of a stock market top, is it still valid now based on the changing economic environment from the 80s and 90s?
You know, I think the retail investor has largely been moving out of equities, and I don't know that that's because they're geniuses looking at valuations and things of that nature. I think they are, like most in the middle class, cash-strapped and concerned about deleveraging and paying off existing bills so that they don't get surprised in the future. So what we've seen in terms of liquidations, both of equity, U.S. equity ETFs and mutual funds, I think is an indicator of again, just how much pressure the middle class is under, not necessarily them moving to the next best thing or having the resources and the wherewithal to sort of sidestep catastrophe. So, you know, I would say that we are in a different environment altogether looking at that particular indicator. This is not a period of income growth, and I think because of that, you have a period of general insecurity across the middle class in investor segment.
That's a great point, David, about there's no income growth. And from what I've read, too, the stories that have come out about this, it seems, I think there's about $16 trillion worth of assets that the American people have either in 401ks or IRAs, but it seems that people are starting to, go through that savings now. They're starting to eat it. They're starting to, eat that seed corn instead of reinvesting it and replanting it into, regrowing their capital.
Yeah, that is typically, I wouldn't say this happens all the time, every day, but there's certainly, on a monthly basis, we run into folks who are drawing down their retirement accounts, even paying a penalty to do so, just to pay off loans and things of that nature, which they consider to be important. So, the amount that is in the retirement pool, even though the total savings rate is moving higher, 5.5% was the most recent savings rate number. I think you're seeing that as no longer tomorrow's retirement fund, but today we have the need fund. In fact, 3 months ago, I had a friend of mine call and say, hey, I've got some expenses coming up. How much would it cost me to liquidate all or a portion of my IRA? And I pleaded with her. I just said, listen, this is not a good idea. There has to be another way. And, of course, there was. But the question of how to spend that kitty, people are thinking not so much about the future. They are thinking about surviving the present.
Now, David, we've seen a lot of jawboning from the Fed for a while. They talked, I think, in 2013 and 2014 about how the economy was improving so much, and I didn't buy it, and I think you didn't buy it based on a lot of your McAlvany weekly commentaries. But the Fed seems determined to at least test the waters and possibly do a rate hike. Do you think the Fed can actually do a token rate hike in the near future, or do you think they're trapped?
Well, John and Jason, I think the fact of the matter is they may do a token rate hike, but you chose your words well. Token would be the best that they could do because the realities of too much debt overhang and the increase in the line item in terms of interest on the national debt would be very painful if they did it meaningfully. Now, why can't they do it meaningfully? Why haven't they done it meaningfully? I mean, I guess the big question is Bernanke promised to start raising rates when we got to an unemployment rate of 6.5%. We were there months ago, and all they're doing is talking. So again, maybe you could argue, well, there's a change of leadership and a change of tone, et cetera, et cetera. I don't buy it. I think they see what is occurring in the guts of the U.S. economy, and they're disheartened. They can't say that publicly, so they still mix their words, and half their message is positive, half their message is ambiguously negative, and it allows them to sort of stay the course. We're now 9 years since they've raised rates. 9 years, the longest stretch of not raising rates since World War II. And I think that in itself is testament to the fact that they are trapped, that there's consequences to the choices that they have in front of them, and they're just simply buying time.
Yeah, those are great points, David. And it seems that the United States and Japan and Europe, they've all chosen, for different reasons, I guess, financial repression, where in Japan's case, they've gotten to the point where even with ultra-low interest rates, they can barely make the interest payments on their debt. There's just no mathematical way for them to pay back their principal without them completely wiping out the principal or taking a big haircut or destroying the value of their currency. But you brought up how onerous it would be if the U.S. did raise rates. I think a 1% rate increase in the United States, that would add over $180 billion in interest payments per 1% increase, right? To the that the U.S. Would have to take out of tax revenues to pay for.
And this is why your word token is so important. I mean, to raise rates 25 basis points, it will indicate to the market that there is a trend change, but it's not a substantive change. Yet they can get away with doing that. Much more than that, and there will be real fiscal issues that will force, things to occur in Washington which today don't appear humanly possible, like balancing a budget, for instance.
Yeah, and do you think the end game then for the United States, Europe, and Japan is to keep doing this financial repression and try to move, in theory, the entire rate curve then in all three of these major developed economic blocks, then either countries or economic blocks, down to as close to zero as possible?
Yeah, repression is an answer. Repression is an answer. You're choosing the winners and losers in the state apparatus via the central banks. The three that you listed are basically saying that savers and the middle class will pay the price for Wall Street and financial market largesse. So all of the bad bets that we're now paying for, the taxpayer is paying for, not only are they paying for in ultimately higher taxes, but they're also going to pay for via an income that should have gone to them as savers, which is instead going to subsidize the rebuilding of financial market balance sheets. So yeah, this is the answer. This is something that they're happy to continue to do as long as people don't ask any questions. And I think this is where the general public needs to say, hey, wait a minute. I've always dreamed of the magic 5%. I've always thought that if I saved, whether it was $100,000 or $10 million for retirement, I could clip my 5% coupon and safely never worry about eating into seed corn. And they're beginning, I think just now beginning, to realize that magic 5% has been snatched away. But it's actually not been snatched away as in taken away, and it's actually been redeployed. And that's what makes this seem like theft, in my mind, is it is taking from savers and those living on a fixed income and redistributing it to Wall Street and, frankly, adding as a subsidy to our national debt. Low rates act as a subsidy for our national debt. All well and good for those who've promised too much to too many, but quite frankly, it's something of a breaking of a social contract if you're looking at people expecting just desserts in terms of savings and income.
Yeah, in terms of subsidy, I think another reason they can't raise rates isn't just because of national debt, but if you also look at corporate debt, I think one of the biggest myths out there is they talk about $1.9 trillion in cash, but what they don't speak about is the over $15 trillion in corporate debt. And since 2008, they've borrowed over $2 trillion, with 95% of that being used for share buybacks and dividends. They didn't go to promote any organic growth within the companies. So if interest rates were to rise, a lot of companies would become insolvent too. And the only way they could issue cash is by either issuing shares or selling off plant and property equipment, which plant and property does not seem realistic.
Yeah, no, I mean, so really they've been doing as corporate managers the unthinkable, thinking about themselves and not thinking about the future. That's what a manager is supposed to do, is look out and offer guidance and vision. That's what the C-suite is intended to do. CEOs, CFOs, CIOs consider your investment options and consider carefully how to best position the company for the future. In this case, I think most of corporate America sees that the growth trend of the 80s and 90s is behind them. We've been struggling to recover that old sense of normalcy via monetary policy, and we haven't done a very good job of it. In other words, the Fed has done everything they can to the tune of printing and creating credit into the trillions of dollars, global central banks into the tens of trillions of dollars, and we're not getting the kind of bang for buck expected. If I were a corporate executive and I were thinking like a criminal, as most of them are, then you'd have to be thinking as, say that the person in China who's 59, expecting retirement in their 60th year, and steals everything. Paper clips, Scotch tape rolls, you name it. There is a social ill in China known as the 59th year. And it's because everyone knows you got to take what you can while you can. That, unfortunately, is the blight we have in corporate America today, where people are thinking of themselves and they're not thinking about shareholders. That they can, and this is the sick irony, is that they can actually pretend to be quote unquote returning shareholder value when really the only thing they want to do in triggering share buybacks or triggering improved earnings per share is trigger their own bonuses. So it's nobody's offering me a golden parachute, so I'm going to get mine. That's the unspoken attitude amongst your corporate executive today. And I agree. They're doing something unconscionable, loading the balance sheet with more debt just to get their bonuses. I mean, because as you mentioned, Jason, you've got the share buyback scheme, which is what most of the debt has gone for.
Yeah. I want to switch to the next topic. Is you're very active in gold. You basically grew up around it with your dad. He did really well in the first gold bull market, and they have this new LBMA, for our listeners who don't know, London Bullion Market Association pricing mechanism that has come out recently. They said it's supposed to fix the London fix, or replace the London fix. What are your thoughts on that, and does it really change anything?
Yeah, I'm not sure that it does change anything. I mean, if it does, it only does so for a short period of time. One thing we know about the markets is that you're still dealing with human nature, and you're still dealing with people who are going to seek an advantage. And this is one of the reasons why operating in the context of the rule of law is so important. Our heritage is a very rich one, looking at how important the application and practice of the rule of law is, because it acts as a leveling field. It levels the playing field for all, which is wonderful. When you end up with problems like you had with the LBMA, and of course I think all of your listeners know there's a myriad, literally dozens of investigations into the manipulation of the gold market, just like there have been dozens of investigations into the manipulation of the currency markets and LIBOR and other markets as well. And so somebody who comes along and says, well, I have something that's not crooked, it's straight. I think it's just a matter of time before that crooked becomes straight. That straight becomes crooked as well, because they don't know that you've fixed. I don't know that you've fixed humanity, and if you haven't fixed humanity, you're going to end up having recurrent problems.
Yeah, there's a great book, David. I don't know if you've read it. It's called Extraordinary Popular Delusions and Madness of Crowds, and it goes back, through the South Sea bubble, the Mississippi bubble, and basically and the Tulip Mania. And basically what I learned from that is, someone's always going to try to manipulate a market, whether it's governments or a special interest group or a group of investment banks or a group of hedge fund managers, with high-frequency trend trading algorithms. So, I mean, even with massive amounts of regulation, they can't fully stop, people trying to manipulate a market.
That's it. That's exactly right. So it may be a short-term improvement, but long-term it doesn't give me much confidence. I tend to have greater confidence in how the market solves problems on a long-term basis, and giving people oversight, giving people control, giving an organization control. I think we'll find that at the end of another 5 or 10 year stretch, people are going to think twice about the issue of faith. And I'm not talking about metaphysical or spiritual faith. I'm talking about the amount of faith that they've extended and put in the quote-unquote powers that be. Whether that is the Fed, whether that is different arms of the government, whether that is Wall Street, the New York Stock Exchange, and NASDAQ. I mean, I think more and more people are going to look at Wall Street and see Bernie Madoff's not just as head of the NASDAQ, but as head of almost every chair in NYSE. I'm not making any claims here. I'm just saying the perception sociologically is going to change, and faith in the experts, quote unquote, will mean revert.
Yeah, and the heads, David, of these New York Stock Exchanges, they're knowingly allowing these high-frequency trading algorithms, these trend traders, they're allowing them to front-run. I was a stockbroker, David, and you've taken your licenses too, and it says right in there, if you front-run and you get caught, you're going to prison for jail for a felony, but yet, every day, these high-frequency trading algorithms get to do it, all the time. So it's just kind of ridiculous that what would be normal rules that apply for you and me, regular guys, the really, high-level Wall Street people, the really rich guys, the rules don't apply to them.
That's right. Didn't we have sort of a foreshadowing of that in Orwell's book Animal Farm? Some pigs are perhaps better than others.
Yeah, or the sheepdog start to police each other, right, and tattletale on each other. I remember in 1984, right, it was the kids who were reporting on their own parents, right, for a thought crime.
That's right.
Okay, well, to continue about the gold theme and John's questions, you travel all over the globe. Are you still having trouble sourcing large order of gold? And our Swiss refiners, the last I heard, they're still running 24/7, 365. But they're getting really old, gold bars and gold coins from a lot of European banks and investment banks. Is that what you're hearing as well?
Yeah, I mean, the interesting thing is for all the down-in-the-mouth attitude and talk on gold in U.S. dollar terms and in the U.S. market, although we are the world's largest economy and a very significant and wonderful country, the interesting thing is there is the rest of the world. And in aggregate, the rest of the world does sort of, on a relative basis, make us look a little bit puny and small. Global GDP is a considerable figure, and we factor into it, but we're not the majority of it. And if you look at what has driven the gold market over the last 10 to 15 years, certainly you can look at elements of central bank demand where they used to be supplying the market, they used to be flooding the market with supply given the old gold agreements. And 2009, they became net purchasers. So that dynamic certainly changed. You certainly have had an increase over the last 20 years in terms of income in your emerging market countries. China is just one example, going from an average annual income of $1,000 to over $4,500 to $5,000 today. And, with people whose suspicion about paper money runs deep culturally, these are people who have continue to buy a considerable amount of gold, taking it off the market more or less permanently. So, in U.S. dollar terms, gold goes down. Not today, but, in the last several weeks, months, and years, it's been in the downtrend. Not so if you're pricing it in Indonesian rupiah. Not so if you're pricing it in Japanese yen. Not so if you're pricing it in euros. So, actually, if you step out of the United States, gold is not in a critically catastrophic bear market. It's either held its own or has done quite well. In the context of the dollar moving up nearly 24% in the last 6-12 months and 40% since 2011, in dollar terms, gold has suffered. But in global terms, and certainly in the last 6 to 12 months, you're looking at 25 and 30% gains. So, while we may say this is bad news, the rest of the world says if you consider it bad news, that's fine. You're the fools who are willing to sell in the open market, and we're the geniuses on the other side of the trade who are willing to buy those assets while you think they're worthless. So it's no surprise at all that refiners are running into old gold looking to be recycled. Because a part of the consequence of lowering interest rates is that your old lease rates on gold are no longer attractive. So the banks and financial institutions, which used to hold a significant amount of gold, are now looking at the gold lease rate and saying, does it make sense to have this asset on the balance sheet? We used to be able to justify it as a hard asset, but really we liked it because of its cash flow. Now the cash flow is gone, and they think like well-trained monkeys, straight from Wall Street, straight from your Ivy Leagues, which is to say if it doesn't have a cash flow, I don't want it. And there is a time to look for cash flow. But this happens to be a time that's fairly treacherous. You lower rates to zero, gold comes pouring out of the banks and out of private hands that have been involved in the gold lease business for years or decades. And, I think this is, guys, Jason, John, this is really critical. The gold that is now being squeezed out of the banks, and frankly, the gold that came to market in the 2009, 10, and 11 period in terms of jewelry recycling, we are talking about one-and-done pressure. Okay, so whatever supply comes to market because of these reasons, again, from the 1,500 to 1,900 price range, people are willing to sell, the wedding ring from their last marriage, or grandma's old jewelry that's out of style and whatnot. No one's looking and no one's asking. No one really considers it a family heirloom anymore because it's in 1960s fashion or whatever. Once it's melted, it's gone. You can't do that again and again and again. So new supplies, either from the recycling side and new supplies coming from banks who could be potential liquidators, they're doing it now. They're doing it now because executive committees are looking and saying, listen, it would be irresponsible for us to sit on an asset that is going down and we can't earn income on it. Let's cut our losses. Let's get rid of it.
Yeah, and to add to your point, David, too, there about the supply, it looks like a lot of these primary gold miners and primary silver miners, if the precious metals price in dollars, if it doesn't start going up again soon, there's just not debt and equity available to them. And many of these miners, they brought projects online in 2009 and afterwards where, they needed $20, $22, $25, $30 an ounce silver. They needed, $13, $14, $1,500 an ounce gold. They've trimmed all the fat that they can at a lot of these mines without actually shutting down the mines. I think we're going to have, I did a video on this on our YouTube channel for our listeners. I think in the next 6 to 12 months, we've just started to see some bankruptcies of some of the larger producers, and we're starting to see M&A. I think we could have, if the metals prices don't start going back up again soon, we could have a pretty decent supply shock in the near future with a lot of these mine production coming offline.
I agree. I totally agree. And the response that my kids have to a decline in the price of gold, it was several Fridays ago, gold was down $30. And of course, I'm not pleased when it goes down, and they could see that written all over my face. They said, "Dad, what's wrong?" I said, "Well, gold's down $30 today." And my oldest is 9 years old, and he said, "That's fantastic. I would like to, I've been buying silver up to this point. I'd really like to own some gold. And if the price keeps on getting better, this is better for me." It's just so refreshing. Why does it have to come from a 9-year-old? Why can't I foster that in my own mind on a more or less perpetual basis? We can easily, those of us even who are in the gold business, can lose track of where we're at and where we're going. And if someone's willing to give up something that is in fact dear for a very small price, we should be willing to step in and buy it. And if someone is willing to pay us a very dear price for it, we should probably give it to them. So that is the classic buy low, sell high, and anyone with their head screwed on straight will be adding to their precious metals position at these or even lower numbers. Well, what if gold's 10% lower? Is that catastrophic? No. What if silver's 10% lower? Is that catastrophic? No. As far as my boys are concerned, they have a treasure box that they want to fill with 10-ounce silver bars, and they know that the cheaper the price, the easier it is for them to fill it. They're ecstatic, and I would hope that others see it the same way.
Yeah, David, to add to your point there, people buy, flat screen TVs when they go on sale. They buy digital cameras when they go on sale. They buy vacations when they go on sale. But, when a good stock and a good company, a dividend stock, quality company like Hershey's Chocolates, when they had a problem in 2009, that thing got creamed. Wall Street downgraded. That was the time to buy. When there's good assets that go on sale, I don't know what it is, why people won't buy investment assets on sale. They want to buy high and sell higher.
Well, that's right. It's very difficult to move against the trend. You have to look at oil and natural gas, and certainly sentiment was very strong, less than a year ago, and now it's very negative, and all you need is a few prognosticators saying, no, it's not 40 that'll be a low. It'll be a 20 that'll be a low. We might even see 12 again. And with the idea that it could go to zero, people tend to project and extrapolate and exaggerate. And therefore, and they do this on the upside too. And it's what we all know is the error of optimism or the error of pessimism. And, at some price, oil and natural gas make a tremendous amount of sense. Copper at some price makes a tremendous amount of sense. But at the price where it makes the most sense, you aren't going to find any support for it. You'll find the vast majority of people liquidating. And I think the value of seeing things from a long-term perspective, not a trader's perspective, not a momentum trader's perspective, but as a long-term asset manager, as someone who's managing assets not only for my generation and the benefit of my wife and I, but for 3 and 4 and 5 generations from now, is that if you are willing to look at long-term trends and buy value when it's on offer, you have no idea the growth potential. And I think that is on offer. That's what we have today. Of course, we have the exact opposite in the equities market, but that's neither here nor there.
Yeah. Speaking of value and everything, I think this brings up an important point that, one, wouldn't you agree with me? This is a perfect example of why you should always keep some powder dried, because right now, $15, well, it's not 15 anymore, but $15 silver was a great opportunity. Some of these silver stocks that were at 30 are now trading at 6. And
yeah.
Go ahead.
Yeah. No, I mean, this is, when we look at asset management, we look and say very simply, this is not perfect. This is not, you can't make this sort of universally applicable. But if you're just trying to teach a principle to your kids, your grandkids, or sit down with a friend who may not know as much as you do about financial matters, have them pull out a napkin, and on the back of the napkin, draw a triangle. What we call our perspective triangle. On the right-hand side, you've got liquidity, cash equivalents, bank savings, short-term T-bills, what have you. On the left-hand side, you've got growth and income. This is your traditional stocks, bonds, what have you. On the base of the triangle, you've got what we call insurance, but which is precisely gold and silver. It insures against volatility, changes in the value of a currency, et cetera, et cetera. And it's something that is a financial asset, but not within the financial system. So you look at that and you say, well, okay, I don't want an equilateral triangle. I don't want a third of my money in gold. Some of our clients want even more than that. But some would say, okay, we'll go with an isosceles triangle and have only 10% in gold with a majority over on the left-hand side. All you're doing really with this triangle is organizing mandates and organizing priorities. And, by keeping cash on the right-hand side, not only do you have some, leniency in the context of a deflation, you have opportunity, which can emerge at any time. And for those who sort of belittle the notion of cash as a strategic asset, I'll just say this: you haven't been around long enough. Keeping some powder dry is absolutely essential. On our wealth management platform, we generally, right now we've got better than a third in cash. Now, Wall Street money managers would generally say that's insane. Look, the stock market's moving up. We know that the Fed's going to be accommodative. We know that the European Central Bank is accommodative. The Bank of Japan still is. It would be insane to not be fully invested. And I just think, well, okay, but you're committing as if you actually know the future. And I think, Jason, one of the things we all know is none of us know the future. So a cash position and, frankly, a gold position represents something of a public statement of humility. We don't know everything. And if things are different than we think, then we have some flexibility to change course without upsetting commitments that we've already made.
Yeah, and there was almost no oil analyst, David, on Wall Street that saw the oil price, starting in June, that saw it crashing. Maybe they saw a little correction, right, going to $65 or $70 a barrel, but no one saw it doing what it did. But yet, if you have dry powder, like you said, there's enormous bargains. There's profitable oil companies out there with good dividend yields that, there's good margin of safety there now that was not there, months ago.
I agree. I mean, we're very close to pulling the trigger on some things like that. So it's, value presents itself, and if you can't take the opportunity as it presents itself, it's unfortunate. But this is where I think a balanced approach to asset management, not having all of your focus on growth, but keeping some liquidity, keeping something in the insurance category. I think that is the best long-term approach.
Well, right now I want to go to another topic. Is since you're in Colorado, I know there's a lot of shale activity there. And speaking of oil, right now, based on average operating costs are around $65 per barrel. With oil now trading at roughly mid-40s, based on what you see in Colorado, do you foresee bankruptcies coming in the near future for a lot of shale oil companies?
Yeah, I do. I think there's one of the issues is how long do we stay at these levels? Because if it is a short-term correction, as in we begin a rebound now, and over the next 3 to 6 months we march towards 65, then the shock to lower prices really is no big deal. It's an industry that's used to volatility. So if it is something cyclical in nature, by all means, 95% of the companies that are in the shale plays, Colorado and otherwise, should be fine, because they can also seek some forbearance. What would be catastrophic is if it ends up being something of a more structural nature. And we're going to have to see what happens when we have additional supply of oil come online from Iran. There's extraneous supplies that can still be brought on from Iraq. And there are probably an extra 2.5 million barrels a day that could still flood the market over the next 24 months, adding even further pressure to the oil price. All of that is contingent on political agreements and things that are anything but set in stone. So it's not a fait accompli. We could very easily recover cyclically. But if there's some political or geopolitical negotiations which occur, we could also see us stay here in $40, $50 barrel oil, and then you would be 12 months from now, then you would start to see real carnage.
Yeah, that's interesting, because there's some bearish oil analysts that say it'll be a W-shaped recovery and we're going to stay down here low for a long time. The mainstream financial media keeps on bringing out analysts, it's going to 30, it's going to 20, it's going to 10, it's going to 12, blah, blah, blah. But, I personally think, I don't know if we'll see a V-shaped recovery, but I was speaking with a money manager friend at lunch last week, and he thought we'd see a U-shaped recovery where, we'd go bottom bounce for another 4, 5, 6 months maybe, and then, we'd start to go higher. But the shale companies, they drilled on debt because of, artificially cheap debt. Mm-hmm. And what has kept them alive is they didn't have dry holes, but they hedged their oil costs at a much higher price. So there's still a lot of these shale producers are still making money because they hedged their oil, but their hedges are coming off in the next 6 to 12 months. And when those hedges come off, they're still going to have all that debt. So they're going to either have to drop supply or go bankrupt. So I think either something has to give in the next couple months. Either the shale companies are going to go bankrupt or the oil price is going to have to go higher. Maybe they'll happen in one or two of the order.
Yeah, and adding to the hedge roll-offs, you also have declining capture rates. I mean, you've got less production coming out of those wells, those new wells, after 12, 24, 36 months. The decline rates, in a lot of instances, are fairly steep. So, it's great up front, great for the first year, not so great the second year, even less so the third. So at about the same time, they've still got the debt to pay. Their assumption was that they could go from one project to the next and basically be able to roll the nut, so to say. You're successful on this project, let's go drill again. And just keep it going. Well, the price has caused them to stop drilling, which means that the decline rates may catch up with them at the same time, or maybe even just before they have to roll their hedges on the existing production.
Yeah, they're not really generating. I think, John, and you cover a lot of oil. I think even at like 100 something a barrel, a lot of these shale producers weren't generating free cash flow. They weren't able to pay dividends, right?
Well, right. Yeah. No, I mean, most of them are geared as a company frankly, as a speculation, where dividends may not be their first priority. So, in all fairness, their structure is, to bring in the money with private investors if they can offer tremendous write-offs up front and some capital gains potential. Yeah, it wasn't necessarily geared towards dividends up front. But I agree. You're talking about companies that they're not structured to survive $40 or $50, and they may not be structured to survive 65.
No, I don't think they were structured for 65. I think a lot of this, the shale oil boom, is just indicative of what would happen if Fed raised interest rates, that it was predicated off higher asset prices and higher oil. And the deleveraging process of the shale oil looks like there's more pain to come. What people forget, in 1987, the savings and loan crisis, that started with a Texas bank getting defaulted from an energy company after the late energies crash. So I don't know if that will happen per se. I think the Fed will come in and backstop like it would, but there are some things that are real brewing in this shale crash.
Yeah, it also depends on how soon that happens. I mean, keep in mind, politics is a nasty business, and if there's some failure within, say, a regional banking context within Texas, I don't know that you can expect. I don't know that you can expect a night on a white horse. This is where a Democratic administration may sort of have their day, saying, listen, you've restructured districts, you've done lots of things in the state of Texas that we don't approve of, and you shouldn't expect us to come to your salvation when you're in a time of trouble. So politics can get nasty, and if there was another significant, obviously a national banking institution, that's different, but a regional banking institution, I think they just let them go.
Now, I'm switching topics, David. We have a strong dollar on the dollar index. It's went up a lot. We have a low oil price simultaneously. Are these two things together really bad for the global economy, in your opinion?
They are bad for the global economy in several respects. I mean, obviously, if you're an energy importer, it's not that big of a deal. Japan is loving it because their energy costs are considerably lower, and they're very dependent on imported oil and energy. But I think the strong dollar, what you're basically seeing is a squeezing of global liquidity. And by having the dollar move higher, any of the debts that have been issued in dollar terms, which are right close to $9 trillion since the beginning of the millennium. So for 15 years, we've got $9 trillion in corporate debts primarily, which have been issued into the emerging markets in foreign currency terms, in U.S. dollar terms. The dollar's up 40% since 2011. You're talking about a difficulty for those borrowers paying back their creditor. And you've just raised the bar considerably. The way I look at it, it's as if interest rates or the interest line item for those borrowers has just gone up 5 to 10-fold. Now, obviously, interest rates haven't gone up, but that's the net effect of having a much higher hurdle, a currency hurdle. They have a currency mismatch where, let's say, for instance, I'm in Bangladesh and I manufacture T-shirts. And I looked at the local interest rates, and they were horrendous. So I went to a U.S. bank, and they organized a bond offering or some sort of a loan, and it was in the 2 to 3% range in U.S. dollar terms. I got suckered in bringing on the loan because of the cheap interest rate. Now, instead of paying the local rates, which could have been 3 or 4 or 5 times that, guess what? I'm having to pay a dollar back, which is 20 to 40% higher. It's killing me. This is how most of your global bond defaults have occurred. If you look at Latin America, the history of Latin American bond defaults have to do with currency mismatches and people's inability or willingness to pay back loans because the currency that they borrowed in is now so far out of reach.
So you think then the developing world then is basically turning into the new subprime because of their massive dollar-denominated debt and how these developing countries have had inflation and how their currencies have gotten smashed against the dollar then?
Yeah, I think what we could see is some sort of a repeat of the tequila crisis, of the Asian financial contagion, where again there was issues within the currency system, and money flowing in and ultimately money flowing out of those countries, which caused destabilization. We're there. It's happening right now. The capital is flowing, and you're seeing currencies crater. I mean, you can look at. I mean, we're not talking about marginal countries when we're talking about Canada or Australia, and yet the Australian currency was above 90 just very recently, and now is in the 70s. So I mean, you're seeing catastrophic moves within the currency markets, which suggest a tremendous amount of stress and strain within the international financial system. Is the dollar the beneficiary of that? To some degree, yeah.
In terms of this currency market, sort of war, and the flight capital and everything, or not flight capital, but the global currency war, do you think Japan is the first to go?
You mean in terms of a collapse of confidence?
Yeah.
The Japanese markets, I think it's very difficult when you're looking at the Japanese markets or the Chinese markets as a Westerner to say exactly what will happen, only because there's so many cultural differences that go so deep. We tend to analyze things as Westerners, and there are other dynamics. I mean, you look at their debt to GDP ratios, and it works for them, whereas it wouldn't work in the Western context, in part because they have a society that is very shame-based, and nobody really wants to talk about certain things. There is open criticism here in the United States. If we think someone is full of crap, we say you're full of crap. If you said that in Japan, I mean, these are things that would be so shameful, would be so humiliating, and so there's a lot of things that are just frankly ignored. Debt levels, companies that have been zombies for decades. These are things that are sort of politely left out of the conversation, and so for me, it's difficult. Does Japan see 300% debt to GDP before their currency is obliterated? I really don't know. It is a question with any market of sort of aggregate confidence, and confidence can break off of the silliest things. So my guess is. My guess is that the Japanese are not the first to go. My guess is that we've already seen, a major move down in a very short period of time in Russia, and it may actually be a country in either Asia or Latin America, not Japan, but another country in Asia or Latin America that has a complete crisis. And it probably will not be as anticipated as the Japanese yen.
That's very interesting. And you brought up Russia, David, and it seems the U.S. government, Obama and the State Department and the Pentagon have plotted this, for years. They basically declared war on Vladimir Putin and Russia. We've seen the U.S. Basically sanctioned debt downgrades of Russian debt, because the U.S. controls those agencies. We've seen the currency of the Russian ruble attacked, seen the oil price. There's clearly not been a lot of full free market forces in the oil market. There's, I think, in my opinion, there was definitely some manipulation there too, one way or another. Why do you think the U.S. is so hell-bent then on, going after in so many different ways Vladimir Putin and Russia?
I think they're afraid of a shift in balance of power, with Europe becoming more dependent on Russian energy. That dependency comes with some strings attached, and I think to the degree that we can break those strings and break the attachment, break the relationship, or restructure it, we'd like to. It was only a few years ago that NATO was becoming quickly irrelevant, and our ability to influence the region was diminishing. So this has given us the opportunity to reflex muscle, rebuild a base of influence in Europe, and try to shift the balance of power back in the direction of the United States. And I say that pragmatically. I don't know that that's ideal. I don't know that that's respectful. I mean, I have a very difficult time when it comes to international relations because I think sometimes the things that ultimately play well for us aren't necessarily fair to someone else. So, judged on the basis of morality or ethics could certainly be criticized. And I think that could be true of what we're doing right now with Russia. This may play well for U.S. Foreign policy, but it certainly is not making friends between us and the Kremlin. Quite the opposite. We've got the Northern Fleet, which is on complete war readiness as of this week. That is the Russian Northern Fleet. And as soon as they went to a war footing, we moved our Patriot missile battery and 100 soldiers to manage it into Poland this week. So I mean, we have these sort of maneuverings, which actually are quite dangerous. And if you roll the clock back to 1914, there was these issues of instability that were just under the surface. Nobody really paid attention to them. They weren't really that big a deal. But then when conflagration started, it was very easy for it to go from a small problem to global conflict. And I fear if we're not careful, we may overstep what we think is just a simple play to regain or regional power in Europe and end up with a global war.
Yeah, and it also seems, David, that they're forcing Putin, back into China's arms, where Putin's going to do more and more, larger natural gas deals with China. Putin's working on a SWIFT system, a global payment system outside, and it looks like they're doing more currency swaps deals to set up bilateral trade and stuff and transition faster to the next global financial system. So the U.S., doing these things to gain power in Europe to destabilize the Ukraine and put their own puppet in. It just seems like, it's causing unintended consequences here where, the U.S., the policymakers in the U.S., the central planners, they don't see the long-term consequences that they're hurting the U.S.'s ability to maintain the world reserve currency and the petrodollar in the long term.
Yeah, add to that, the normal conflict that we have in the Middle East, the sort of the ongoing conflict between the Shia and the Sunni. And, again, we're trying to choose winners and losers, reshape sort of the world as we want it to be. And look at our foreign policy right now. We are, in fact, sort of moving towards a friendly footing with Iran. How do you think that sits with the Saudis? How do you think that sits with Turkey? How do you think that sits with Syria and Israel? I mean, going back to the old Shia-Sunni conflict, you're doing things that right now anger the majority of the Islamic world against us. I mean, that's. I don't know how smart that is. I just don't know how smart that is.
This seems like the Roman strategy of divide and conquer, where they play both sides, because we used to not necessarily do that as much. We as in the United States foreign policy, we'd pick a side, but it seems that now we're disrupting both sides, and we see pictures of John McCain, with Syria Al Qaeda people last year, the year before, photos and things like that, and we're training all these groups. It's just mind-boggling all the stuff the U.S. foreign policy is doing right now.
Well, maybe there's someone out there that's far smarter than all three of us combined, who gets it, who understands it, who has the mind of Machiavelli, and sees it and can put a seal of approval on it. But I certainly have a hard time stomaching it myself.
Now, my final question for you, David, before we let you go, has to deal with the SDR special drawing right. It seems, we've heard Jim Rickards come out and say, China wants the SDR. Maybe they'll agree to it for a transition, but we also see, Russia, China, India, so many other developing world countries buying massive amounts of gold. Do you think you've said repeatedly that you don't think the dollar as a world reserve currency is going to last that much longer. Do you think the next system is going to be centered around the SDR with a basket of currencies with RMB in there, or do you think it's going to be a different type of system, maybe with a global, maybe gold-backed trade settlement or something?
When you look at the SDR system, it's too synthetic to actually work as a true and actual currency for trade settlement. It works very well amongst central banks, but it doesn't work well for any other commercial purposes. But what you do see is sort of a leveling of the playing field. You've got not one currency, but many in a basket, and I think that will act as a model for a future global monetary system where, a trade-weighted basket of some sort, which would include the RMB, which would include the yen, which would include the euro, which would include the dollar doesn't become irrelevant, and the dollar doesn't go away as a world reserve currency. It just goes away as the world reserve currency. And by losing some stature and market share, I think you can expect to see the value of the dollar drop pretty considerably.
So then you don't think the Chinese want a yuan as a world reserve currency, and you don't think they want a gold standard, or do you think maybe that's a long-term plan for 10, 20, 30 years out, and the Chinese are willing then to go along with the SDR for in the next 5 years and go along with it to be implemented for a decade until they're ready to fully open up the currency then?
Well, I think a new currency system, in order to be accepted globally, you're talking about any change to the existing system being as a consequence of crisis. Nobody's going to change what we have unless there's a reason to, and that reason would have to be fairly severe. So if we assume that there is a future monetary crisis and in its place is some other system, I think gold has to be a part of that system. That for 5,000 years has been what people have returned to as something solid, as something real, as something tangible, as something that serves as the base for confidence and trust. When people lose confidence in people, you have to have something outside of that network of relationships that re-solidifies trust. And that's why gold has been the go-to. Gold will be a part of it. But the Chinese, again, if you made something in the new monetary regime trade-weighted in basis, they may say, it doesn't matter that we're not the majority in terms of global trade today. We're going to continue to grow our economy to where we're 70% of the global economy. And on a trade-weighted basis, the RMB is the world's reserve currency by default. Yeah, they don't need it overnight. They can work towards it. It keeps them from making some pretty major commitments up front. They would have today an inability to be the world's reserve currency because their capital markets aren't deep enough, because their debt markets aren't deep enough. But on the other hand, they might be 25 years from now, and their quote-unquote market share in terms of global GDP or total world trade in that time frame will probably have grown. So as long as the new monetary system writes into it, or has written into it, the condition of trade weighting, I think they will very confidently move towards something like that. And with gold as a basis, people will have no reason, and with a lot of gold on deposit in their own country, people will have no reason to question the solidity of the RMB.
Yeah, and even if the Chinese don't, go to a gold-backed RMB or yuan, I think they're still going to continue to accumulate massive amounts of physical gold. I think 2013 and 2014, according to Kuz Johnson of Bullion Star, they accumulated over 100% of annual global mining supply. They're on pace to do it again already in 2015. I think they've already imported over 500 tons of physical gold into the Shanghai Gold Exchange already this year. So I don't see a scenario where Russia, China, India, Asia, the Middle East, where they stop buying massive amounts of physical gold for a long time, as long as, Japan and Europe and the United States are all trying to, do quantitative easing and rapidly devalue their currencies.
Won't it be interesting when they eclipse the United States in terms of total tonnage, and they're willing to offer independent audits, let's say, Ernst & Young or, 3 other different accounting firms come in and audit their gold, and then just put that out there publicly, and then have the U.S. respond with, well, it's really not necessary to do that. It's really unimportant to have done that audit. That just suggests their general insecurity as they sort of create an excuse for not having their own gold audited. It'll be interesting to see how they play their gold holdings in the future, but that's going to be a big card. That'll be a big card. But be very careful as to when they play it, and it'll be played at a time when it has real significant effect.
In the past, I think, David, they had announced their new physical gold holdings every 5 years. So they're due to, I think, announce it by the end of this year. And there's a number of gold experts out there that think they will, but I'm not sure if they will or not. But I think I also read some articles from other people with some numbers. When you add up the amount of private gold in China that's already been imported, since China opened their gold market back up to allowing private citizens to buy gold again legally, that people think that there's already 30,000 tons of physical gold in China, although, that's not with the People's Bank of China. That's combining the People's Bank holdings plus the private sector holdings.
Yeah, it will be interesting to see. I mean, we know from our time spent in both Shanghai and Beijing that the appetite is voracious. We've spent some time with gold analysts, some storage facilities, and traders at the Shanghai Gold Exchange, and they are transforming themselves. It'll take a little bit more time, but they are transforming themselves into an organization in a region which could dominate the whole gold market, making Chicago, New York, London very insignificant in the gold trade.
Well, David, I just want to say we're out of questions, and we just want to thank you for your time. If more people want to find out more about you, how can they do so?
Yep, McAlvany.com is the best place to find us. That will link you to a variety of the things that we do, our wealth management service, our precious metals brokerage, our weekly commentary. You guys have been listening. This month we celebrate 7 years of doing the weekly commentary every week, and it's been a great exercise, and for those who've been listening for the last 7 years, quite an education as well. So those would be great ways to sort of tap into what we're doing, and keep your eyes open. Here in the next 90 to 120 days, I'll have a book released dealing with legacy and kind of looking towards generational considerations of family values and managing what is a family's true wealth.
Oh, that's very interesting. Maybe you'll send us a review copy of the book, and we'll take a look at it and have you back on again. Well, we have you on every couple months because I just enjoy speaking to you. You're one of my favorite analysts out there.
Well, I think you'll enjoy the book. It's definitely been a labor of love and very sort of revelatory in terms of our family and our history, our story. But something that we hope is an encouragement to others, and perhaps a slight change in conversation, because only about 20% of it deals with financial wealth. A lot of it deals with managing other resources, which are as or more vital for a family as they look to the future.
That's it. That's very interesting. It's not the normal stuff the McAlvany Weekly Commentary covers, but I'm always looking to challenge, learning new things. I think that's very important. Well, again, David, I want to thank you very much for your time. I've had you on almost for an hour. I think I could talk with you for a couple hours and not get bored. I really enjoyed discussing things with you. But thanks again for your time, David, and we'll have you back on again in a couple months, hopefully.
Thanks, John. Thanks, Jason. You have a great day.